Ever pondered what the term equity means in the world of finance and investing? Why is it so central to the financial market? Today, we're going to unravel the mystery of equity. It's a term that's frequently tossed around in financial circles. But what does it really mean? Let's break it down in a way that's easy to understand. Imagine owning a house. You've paid off a portion of your mortgage, but you still owe some money to the bank. The part of the house that you truly own, after subtracting what you owe, is your equity in the house. Now let's take this concept and apply it to the world of finance and investing. In this realm, equity refers to ownership in any asset, once all debts associated with that asset are paid off. When you purchase stock in a company, for example, you are buying a piece of that company's equity. You become a shareholder, an owner in the company, entitled to a share of the company's net assets. Equity is central to the financial market because it is the foundation upon which wealth is built. It represents an investment, a stake in a company or property, and the potential for future profits. When a company's value grows, so does the equity of its shareholders. But it's not just about profits. Equity also signifies risk, as shareholders are the last in line to be paid if a company goes bankrupt. They stand to lose their entire investment if the company's assets are not enough to pay off its debts. In the world of business, equity is also crucial. It is the value that a business has after all its debts and liabilities have been paid off. This is the value that the business owners have truly built and can claim as their own. So, in essence, equity signifies the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. Now, imagine you own a business. How does equity come into play here? In the world of business, equity takes on a slightly different yet equally vital role. It's not just about fairness and balance. Instead, it's about ownership, control, and potential profit. You see, in a business context, equity generally refers to the value of an ownership interest in the business. This might be shares of stock if you're dealing with a corporation, or it could be membership interests in a limited liability company. Let's break it down. When you start a business, you're essentially creating something from nothing. You invest time, money, resources, and perhaps most importantly, your ideas. This initial investment, this seed you plant, is your equity. As the business grows and develops, that equity can increase in value. Think of it as a pie. In the beginning, you own the whole pie because you're the only one who has put anything into it. But as you bring in more investors or issue stock, you're essentially cutting up that pie and giving away pieces. Now, this might sound like you're losing out, right? Well, not necessarily. While it's true that you're giving away a portion of your pie, remember that the overall size of the pie can also grow. Your smaller piece of a larger pie could ultimately be worth more than your initial whole pie. Moreover, the amount of equity you hold in a business also determines your level of control over business decisions. If you own a majority of the equity, you have a majority of the voting power. That means you can steer the business in the direction you see fit. But it's important to remember that with great power comes great responsibility. As an equity holder, you also share in the business's losses. If the business doesn't perform well, your equity could decrease in value, or in the worst case, become worthless. Thus, in a business scenario, equity translates to ownership. The more equity you hold, the larger your share of the pie, and consequently, the more control you have. So, how does this all relate to investing, you may ask? Let's dive in. Equity investing is a fundamental concept in the world of finance, and it's one that every investor, whether novice or seasoned, should be intimately familiar with. At its core, equity investing refers to the process of purchasing and holding shares of stock in a company. But it's more than just owning a piece of paper or a digital record. When you buy shares, you're essentially buying a piece of the company itself. You become a shareholder, a part owner of that business. Why would anyone want to do this? The answer lies in two key benefits: dividends and capital gains. Dividends are a portion of a company's profits that are distributed to shareholders. They're like a thank you gift from the company for investing in them. Capital gains, on the other hand, come from selling your shares for more than you bought them for. If the company does well, its stock price will likely go up, and you can sell your shares at a profit. But keep in mind, the goal of equity investing isn't just to make a quick buck. The real power of equity investing comes from the potential for long-term growth. Over time, successful companies tend to increase in value, which means the value of your shares can also grow. This is why many investors choose to reinvest their dividends, buying even more shares, and thus potentially increasing their future profits. Equity investing is also a key tool for hedging against inflation. As the cost of living rises, so too does the value of successful companies and, by extension, their stock. By investing in equity, you can potentially preserve and even grow your wealth, even in the face of rising prices. So, the next time you hear the term equity investing, remember it's not just about buying shares. It's about becoming a part owner in a company, reaping the rewards of its success, and using this as a strategy to grow your wealth over time. In investing, equity is a way for individuals to grow their wealth and hedge against inflation. Scene script. Like any financial venture, equity comes with its share of risks and rewards. What might these be? Well, let's start with the risks. The most apparent risk of equity is the potential for loss. When you buy equity, you're essentially buying a piece of a company. If that company's value decreases, so does the value of your equity. In the worst-case scenario, a company could go bankrupt, and your equity could become worthless. This is the risk of capital loss, and it's a risk that every equity investor faces. However, it's not just about the risk of losing money. There's also the risk of opportunity cost. When you put your money into equity, you're choosing not to put it elsewhere. If those other investments would have performed better, you've lost out on potential returns. This is the risk of missed opportunities, and it's another factor to consider when investing in equity. But let's not forget about the rewards. The potential for high returns is one of the most attractive aspects of equity investing. If the company you've invested in does well, the value of your equity can increase significantly. You could potentially earn a lot more than you would with safer investments, like bonds or savings accounts. Moreover, when you own equity, you often have the right to a share of the company's profits, usually in the form of dividends. These dividends can provide a steady stream of income, in addition to any potential increase in the value of your equity. There's also the reward of ownership. When you buy equity, you become a part owner of the company. This means you have a say in how the company is run, which can be both a financial and a personal reward. In summary, equity investing is a game of balancing risks and rewards. The potential for loss is real, but so is the potential for significant financial returns. And it's not just about the money. Equity investing can also provide the satisfaction of ownership and the thrill of being part of a successful business venture. As with all investments, understanding the balance between risk and reward is key to successful equity investing. So, what should you remember about equity in finance and investing? At its core, equity is a claim on the assets and earnings of a business. It's that slice of the pie that gives you ownership, control, and a share in the potential profits. It's your stake in the game, your skin in the game, your ticket to the big leagues. But equity isn't just about ownership, it's also about balance. In the business world, equity is the balancing figure in a company's financial equation, bridging the gap between assets and liabilities. It's the financial fulcrum that keeps a business steady, ensuring that the books balance and that the company can keep moving forward. When it comes to investing, equity takes on yet another role. Here, it's not just about ownership and balance, but also about potential. Equity investments, such as stocks, offer the potential for significant returns. They give you a piece of a company's future, a chance to ride the wave of its success. But with that potential comes risk. The risk that the company may not succeed, that your investment may lose value. This brings us to the risks and rewards of equity. Like any financial tool, equity has its ups and downs. On the one hand, it offers the potential for significant returns and gives you a say in the direction of a company. On the other hand, it exposes you to the risk of loss, as the company's performance can directly affect your investment's value. The key is to strike a balance, to understand the risks and rewards, to weigh the potential against the possible pitfalls. It's about making informed decisions, being strategic in your choices, and always keeping an eye on the bigger picture. Equity, in its many forms, is a powerful tool in finance and investing. It can be your key to ownership, control, and potential wealth growth. But remember, with great power comes great responsibility. Make your equity decisions wisely.